All right, diving in today, folks, we're taking a deep look at the 2023 annual report from Henderson Land Development Company Limited.
Yeah, I think people hear annual report and their eyes glaze over a bit.
But honestly, this one's got some juice to it, wouldn't you say?
For sure. I mean, it's not just the financials that we'll get into those too, but it really lays out their whole picture.
Right, from the ground up. We're talking property development, of course, that's their bread and butter.
Right.
But then department stores, supermarkets, even gas companies and ferries.
And awards. Don't forget they won a bunch of awards for their new stuff.
Absolutely, all kinds of accolades, which tell us something about their direction. So our mission today, if you will, is to break this down, make sense of it for anyone interested in where Henderson Land is going, how they're doing it, the big picture stuff.
And the details that make it interesting.
Exactly, the stuff that makes you go, I didn't know that. So first off, just to lay the groundwork, their core is property development and investments, right?
Right.
But it's how far they branch out from there that's pretty wild.
It's strategic diversification for sure.
Right, so they're not just building condos, they're running Citistore, APT, UNY. Those are the department stores and supermarkets.
Mm-hmm. And then you've got the Miramar Hotel Group. That's hotels and those service departments, which is a whole other ball game.
Right. And then on top of all that, they've got serious investments in Hong Kong and China Gas Company, HKCG for short, and Hong Kong Ferry, that's HKF. How do all these seemingly different businesses work together?
Well, I think you see it when you look closer. For example, their retail businesses give them a really good grasp of what consumers want, right?
Makes sense.
So that knowledge feeds back into how they design their developments, the commercial spaces they create. You want those shops to be attractive, in the right places. It's all connected.
So it's not just building in a vacuum.
Exactly. And then the infrastructure plays, like the gas and ferry stuff. While they're kind of their own things, they also show Henderson Land's long game commitment to Hong Kong.
Right, it's like being part of the fabric of the city.
Exactly. And those are also more stable, regulated income streams, which can be helpful to balance out the property market, which can go up and down.
It's all about balance, isn't it? Now, speaking of property, the report really highlights how Kowloon East has become this core business district, and their properties there have done extremely well. They mentioned Manulife Financial Center and AIA Financial Center specifically. What did they do right in that area?
I think their success there is a testament to long-term vision, honestly. They saw the potential for Kowloon East to become a major hub early on, even when it wasn't as obvious to everyone else.
So they were ahead of the curve.
Definitely. And they didn't just build towers, they actually invested in the whole ecosystem of the district.
Infrastructure.
Yeah, amenities, making it a place where businesses actually wanted to be. And that takes time. It's not just about the buildings themselves.
Right. It's got to be a desirable location for people, too.
Absolutely. And that's what they've achieved.
Now, they've got this brand new flagship building just finished this year, the Henderson.
Ah, yes, the Henderson. It's all over the news, all the design magazines.
And they're not shy about touting its smart technology and eco-friendliness. All the awards it's winning. What makes it so special?
It's like a showcase for what the future of office buildings could be. They've really leaned into sustainability and tenant well-being, which is becoming more and more important these days.
Right. It's not just about square footage anymore.
Exactly. And they've got this really innovative program called the Landlord Individual Tenant ESG Partnership Program, which encourages tenants to actively participate in sustainability initiatives.
Oh, interesting. So it's collaborative.
Yeah, it's not just on the landlord to make the building green. It's a shared responsibility. And then all those certifications, they've got Smart Score, LEED pre-certification, Wired Score. They're proof that they're walking the walk, not just talking the talk.
Right. It's like third-party validation. Now, let's shift gears a bit and talk about mainland China. Their leasing market seems to be facing some challenges, slower growth, more competition.
Yeah.
But they're still seeing growth with new properties like Lumina Guangzhou and Lumina Shanghai. How are they handling this tougher environment?
Well, the mainland market is definitely a different beast compared to Hong Kong. It's more volatile, more players, more factors at play. But Henderson Land's strategy seems to be about focusing on quality.
Prime locations.
Yeah, top-tier developments in those major cities, Guangzhou, Shanghai, where there's still strong demand, even when the broader economy slows down a bit.
Right.
They're not chasing every opportunity, they're being selective.
So it's about choosing their battles.
Exactly. But the report does mention the impact of currency fluctuations, with the renminbi and Hong Kong dollar. That's always a risk when you're dealing across borders.
Makes sense. That's something out of their control.
It is. And we also see that their net rental income took a little dip. which is partly due to the initial costs of these new large-scale projects.
Right, it takes
Finally.
time to ramp up and fill those spaces.
Exactly. It's a normal part of the development cycle. It'll be
Mhm.
interesting to see how those numbers look in the next report.
Something to keep an eye on. Now, another thing that jumped out at me is their focus on green building standards in their Shanghai properties. They're getting all these certifications, like, well, health safety rating and true zero waste. How important is that in the mainland market?
Oh, those certifications are becoming gold, especially for attracting those premium tenants, multinational companies, the ones who are really conscious of their image.
Right, it's like a badge of honor.
Exactly. And it's not just about image either. It can actually save them money in the long run with lower energy bills and less waste.
So it's good business sense too.
Absolutely. And when you look at their leasing rates for some of those Shanghai properties, like Henderson 688, they're doing very well. So it seems to be working.
It's all adding up. Now, shifting gears again, let's talk about their retail side with Citastore and Unicorn. It seems like a pretty steady, if less flashy, part of their business.
Yeah, these are more mature businesses catering to the local communities. You're not going to see the explosive growth you get with a new development project, but they provide a stable income stream.
So it's about maintaining a presence.
Exactly. And it's about adapting to the changing retail landscape, online shopping and all that. But those brands have a lot of loyalty built up, and that's valuable.
It's about trust. Now, the Miramar Hotel business, they had a really strong rebound in revenue, even swung back to profit after a tough couple of years.
Yeah, the travel industry got hammered during the pandemic, but it seems like things are bouncing back nicely now.
Pent-up demand.
Definitely.
Yeah.
People are eager to travel again, and Miramar was ready to capitalize on that. But of course, how long this boom lasts depends on the global economy and people's confidence in traveling.
Fingers crossed. Now, let's talk about HKCG, their gas company. They're making some interesting moves into hydrogen energy, even pilot projects for hydrogen buses and EV charging. Is this a major shift for them?
It's definitely a sign they're thinking about the future. Their core business is still gas distribution, but they're clearly aware that the energy landscape is changing.
Going green.
Yeah, hydrogen is being touted as a clean energy source, and they're getting a head start. Plus, they can leverage their existing infrastructure and expertise in gas handling. But it's early days. We'll have to see how it plays out.
It's a gamble. Now, they also sold off their stake in Shanghai Gas. What's the story there?
That was an interesting move. It seems like they're consolidating their focus, putting their resources where they see the most potential for growth or where they have more control.
Strategic retreat.
You could see it that way. They're still heavily invested in mainland China. They're just being more selective. And the cash they got from that sale can be used for other things, like those hydrogen projects or even their new venture into sustainable aviation fuel.
Oh, right. Tell me about that.
So they've invested in a company called EcoSeries, which produces SAF from waste products.
So it's like recycling, but for fuel.
Kind of, yeah. And the aviation industry is under a lot of pressure to reduce its carbon footprint, so SF is becoming a big deal. This is a smart move by HKCG, tapping into a growing market that's aligned with global sustainability goals.
It's a win-win. Now, lastly, Hong Kong Ferry, their profit took a hit this year, but that seems to be because of that one-off property sale last year.
Yeah, that Royal development skewed the numbers a bit. If you look at their core businesses, it's a more stable picture. Rental income from their commercial properties is doing well, and they've got high occupancy rates.
Solid foundation.
Yeah, and the small deficit in their ferry operations, they're expecting to address that with a fare increase.
Makes sense. And then there's their foray into medical aesthetics with Amour, which seems to be growing rapidly, though still not profitable.
Yeah, that's a bit of a wild card, isn't it? It's a completely different field for them, but it's growing fast, especially in Asia.
So they're experimenting a bit.
They are. And their new Total Healthcare Specialist Center is already turning a profit, so that's a good sign. It's all about diversifying and finding new avenues for growth.
Now, we can't forget the government's recent decision to abolish those stamp duties, which seems to have given their residential property sales a real boost.
Oh, yeah, that had an immediate impact. It shows just how sensitive the Hong Kong property market is to government policy. But it also indicates there's a lot of pent-up demand from buyers. They were just waiting for the right conditions.
Makes sense. So a lot of moving parts here across all these different segments. Taking a step back, what's their overall growth strategy looking like? Urban redevelopment seems to be a major focus.
Oh, absolutely. In a place like Hong Kong, where land is so scarce, redevelopment is key. And they've got a huge pipeline of projects in the works. Something like 2.4 million square feet of potential development.
That's massive.
It is. They're not just waiting around for opportunities. They're actively acquiring land in prime areas like Wan and Quarry Bay, making sure they have a steady stream of projects for years to come.
So it's about securing their future.
Exactly. And then you've got the new Central Harborfront project, which is a monster development, a whole new landmark for Hong Kong. That's a long-term play. It's not going to be finished for another decade or so, but it shows their ambition.
It's a legacy project.
Yeah, and it's not just about the buildings. It's about creating a whole new public space, a new waterfront for the city. That's a big deal.
And then there's their land bank in the New Territories North, which is substantial.
Yeah, they're well positioned to benefit from the government's plans to develop those areas. That's a long-term bet, but it could pay off big time.
A lot of potential up there. Now, the report mentions a significant amount of contracted sales yet to be recognized. What does that tell us about their near-term outlook?
Well, it means they've got a lot of revenue already lined up from projects that are in progress. It gives them a good level of certainty and helps smooth out any bumps in the road.
So they're not starting from scratch each year.
Exactly. And in mainland China, they've been steadily growing their investment property portfolio, especially with the completion of that Chengdu ICC tower.
So they're playing the long game there, too.
Yeah, they're committed to the mainland market, even with the challenges. Those completed properties generate a steady stream of rental income, and they're diversifying their portfolio across different cities and types of properties.
Spreading the risk. And they've got other big projects in the pipeline, like those in Shenzhen and Shijiazhuang.
Those are huge developments, showing their range from high-end urban complexes to large-scale community projects. They're really catering to the whole spectrum of the market.
And back in Hong Kong, there's Gateway Square Mile, which is almost finished.
Yeah, they've got a good mix of projects at different stages, which keeps things moving. They're not putting all their eggs in one basket.
Right, let's dig into the financials now. Their underlying profit saw a small increase. Why do they emphasize underlying profit?
Well, underlying profit gives you a better picture of their core operations because it strips out things like the changes in the value of their investment properties.
Which can be volatile.
Exactly. So it's a more accurate reflection of how their businesses are actually performing. And a small increase is still an increase, which is good to see in this environment.
Now, they did report a fair value loss on their listed investments. What does that tell us?
That's just the stock market doing its thing, really. It's a reminder that they're not immune to external factors, but it's not necessarily a reflection of their underlying business performance.
The paper losses.
Exactly. But on the other hand, they had a big one-off gain related to Sunlight REIT.
What happened there?
So they increased their ownership in Sunlight REIT to a point where it became an associate company, which triggered an accounting gain. It's kind of a technicality, but it boosted their profit for the year.
It's all about the accounting rules. Now, their gross revenue from property sales increased, which is good news.
Yeah, that's a key driver of their business, and it shows there's still healthy demand for their properties, both in Hong Kong and mainland China.
And their pre-tax profit contribution from investment properties also increased. What drove that?
Well, their subsidiaries saw higher rental income from some of their key properties in Hong Kong, and their operating expenses were lower. And then the increase from associates is mainly due to Sunlight REIT becoming an associate.
So that acquisition's already paying off.
It seems so. But as we mentioned earlier, the profit contribution from the Royale decreased.
Right, that was a one-off thing last year.
Exactly. And their profits from joint ventures were a bit of a mixed bag. The overall number increased, but their underlying profit from those ventures actually decreased.
Why the discrepancy?
Well, the overall increase was due to some fair value gains, but their actual operating profit was lower, partly because of higher financing costs.
So it's important to look beyond the headline number.
Exactly. And speaking of financing costs, their overall borrowing rate jumped up significantly. Yeah, that's the impact of rising interest rates globally. It's going to make things more expensive for them, and it's something they'll need to manage carefully.
The headwind. And there was also a decrease in the fair value of their investment properties.
That's just a reflection of the market, really. Property valuations can go up and down, and it's something that's out of their control, but it does impact their reported net asset value.
It's all connected. Now, finally, let's talk about shareholder value. They paid an interim dividend and recommended a final dividend.
Yep, so that's HK $2.50 per share already paid out, and another HK $1.30 per share proposed for a total of HK $1.80 for the year. That's a pretty decent return for shareholders.
Not bad. And what about share buybacks? Any plans there?
The report doesn't mention anything specific about share buybacks, but they're in a strong financial position. They generate a lot of cash, so they definitely have the option to do buybacks if they want to.
It's a tool in their toolbox.
Well,
Okay, so looking ahead, what's your overall assessment of Henderson Land?
I think they're in a pretty good spot, all things considered. They've got a solid foundation with their land bank and redevelopment pipeline, which will keep them busy for years to come.
And they're diversified.
Exactly. They're not relying on any one market or sector, and they're making smart moves into areas like green energy and healthcare, which have a lot of potential for growth.
But there are challenges too.
Of course. The mainland market is unpredictable, and rising interest rates are a concern. But they've navigated tough times before, and they seem to have a good handle on things.
So it's a wait-and-see approach.
I think so.
Right.
But they're definitely a company to watch. They're not afraid to take risks and try new things, and that's what keeps them ahead of the curve.
Well, this has been a fascinating deep dive into Henderson Land. Thanks for your insights.
My pleasure.
Now, for our listeners, here's something to ponder. We've talked a lot about their land bank and diversification, but thinking even further out, how might technological disruptions and shifting societal priorities beyond just sustainability shape their decisions in the coming decades? Things like smart cities, personalized well-being, the metaverse, who knows? What will the future hold for a company like Henderson Land? Something to keep in mind as you watch them evolve. Until next time, keep exploring.
Absolutely.
Thanks for joining us on The Deep Dive.
Thanks next time.